All right, what's going on, traders? It's your boy Market J from Market Assassins Corp. So I'm here today to talk to you guys about a trade that we made today and an opportunity that we can see today in today's market. Now, the reason we're having this discussion, as you guys can see, the market is still open. It's currently 3:55. We got about 4.5 minutes before the market closes. Now, today was the FOMC meeting. And we actually happen to take this trade every FOMC in terms of the interest rates. But the reason we're putting out this video now is there's an opportunity that I'm seeing in the market, and part of it is already played out. And we don't normally do this, but we are going to provide this to the public one time for free, and also break down the analysis. And this is something that can help you guys as traders to carry on other trades moving forward. So what I want you to do is think about it like this, is with the interest rates, we know about interest rates and the Fed decision coming for 2 months. What a lot of people fail to realize is whenever you're hearing about, these interest rates going up or down, the market is already pricing in whatever the rate expectation is. And the expectation for the better part of 2 months has been for the Feds to increase rates by 75 basis points. So when a lot of people see the FOMC meetings and they're like, hey, the Feds just raised the interest rates and the economy's bad or inflation is high, but the market seems to rally every single time. That's why, because the market was already pricing in whatever it was that the Fed decided to raise their interest rates to. Now, when you see that the market does not anticipate the rate decision correctly, you get to see a negative ramification most of the time. So if the Fed had raised interest rates by 100 basis points, how some people had thought after the recent CPI report, then what you would have saw was a dramatic sell-off. So I tend to tell my team and my traders to avoid trading when the report comes out. As you can see, the report came out at 2 o'clock that the rate decision was going to be raised by 75 basis points, which it was, and the market reaction went lower. We always miss out on this because we don't want to get slaughtered with the sheep, and that's what we want to avoid. So if someone went short here, fantastic, but hopefully they took profits. What we actually did is we flipped long. And what we did is you always want to have your line in the sand of where it is that you're looking to get in. So we don't trade at 2 o'clock when the report comes out. We don't even trade at 2:30 when Powell starts talking. We wait a little bit for the initial reaction. And this is basically what I had here. This yellow line is my line in the sand of where I'm interested. As beginning traders, you want to wait for price action to cross your level. As an advanced trader, when you see momentum picking up, you want to be able to anticipate price action crossing your level. So at 2:31, when Powell started speaking, we saw that momentum and that pull down. So I got into 3,900 calls right up over here at 1432, which is 232. All right, I sent the alert to the team, and as you guys can see, SPX went from 38.35 all the way up to 39.07. Now, I didn't take profits way up here. Some people were able to take advantage of 150% on this day trade. I took 94%, 92, 94%, something like that. And as you can see, we actually had a little bit of a pullback. So, because I actually took profits right here during this red print. And the reason we're talking about this, it's not because of the day trade that we made today. It's about the opportunity that I'm seeing in the market at this very moment. When we pull down to this 38.80 level, and this is what you guys need to use, and it's multi-time frame analysis. This can help take your trading to another level. If you guys aren't incorporating multiple time frame analysis in your trading, you will struggle because you will always miss the bigger picture. So when the price action came down to 38.80 and Let's say 2 days from now, for those of you who have Thinkorswim, you can put on the on-demand feature at the time that I'm telling you, and you will see the structure and price action that I'm telling you and the dynamics of what allowed us to take advantage of the trade. All right, so the market just closed. And what happened is when we pulled down to 38.80, if you were to flip out to the daily chart at the time, it's not going to show it now because we've moved dramatically lower. But up here, this end of the body was a wick, all right? Because we came from down there in 38.80, it actually had created a doji, all right? For those of you who don't know what a doji is a candlestick where you're seeing a wick on the top and the bottom of a chart. So this right here is a doji. This is a perfect example of a doji. When you're seeing these wicks at the top and the bottom of a daily chart, that is letting you know that there was no strength from buyers or sellers, all right? There was no strength from either of the two. Neither were aggressive to push price in either direction. That is known as indecision. That is a pattern, all right? I do not trade these head and shoulder patterns, these bear flag patterns, bull flag patterns. I know what they are. I look for them only in large time frames, all right? Not on a daily. I don't care about a pattern like that on the daily. But what I do care about is indecision, because that is a pattern when you see strength. Think about it. If the market has been pricing in for 2 months for the Feds to increase interest rates by 75 basis points for 2 months, and the market gets what they anticipated, all right? And every FOMC has created and sparked a rally, and now you're looking at a chart and you're seeing indecision. Think about that. What does that tell you? That is the ultimate sign of weakness, and that's why I say that is a pattern. A pattern is not always what you guys believe it to be in terms of a head and shoulders. Think of what a pattern means. A pattern basically means a behavior, because that's in all honesty what we're trading. We are trading psychological behaviors. So when you're seeing a behavioral change and something that should have behavioral strength, that is a sign of weakness. So what we ended up doing is we actually flipped out into SPY puts, all right, early into the 3 o'clock hour, and we're actually in the money now. These puts are now currently up over 300%. So we went short on the market when the market came down to 386. And the reason being is because once we saw that weakness, I actually alerted the team that we could see at minimum a 100-point move in the market. So you're talking about SPX coming down from that 38.80 all the way down to 37.80 at the minimum. That has been met today before the market closed. This is a swing trade. All right. So what I'm actually expecting is more downside to occur. And the reason we're talking about this is an opportunity that we're seeing in the market that we're sharing with the public. Unfortunately, the market closed. So if you guys are seeing this after the market, yeah, you couldn't get into the opportunity. If you guys are holding short positions in the market, that's something you want to be aware of so you understand the dynamics of what's occurring and what potentially that you could see. All right. Now, like I said, the floor is 100 points. I'm looking anywhere between 100 point to 160 point move. All right. So there's still meat left on the bone. At minimum, there's 10 points, 9 to 10 points left on the bone on those puts. All right, which would equal out when you're talking about SPY. SPY is the inverse of SPX. One moves in $10 intervals, the other one moves in $1 intervals. They are deviations of the S&P 500 to be exact. All right. So hope you guys like the video. It's your boy Market J, and I will see you guys another time.